We're talking about the silver price and the lack of action that we've been seeing all summer with Jeff Christian, managing partner of the CPM Group. Jeff, welcome back to the show. I know you were traveling last week, and I'm happy to see that you're back. I'm going to start by showing you a chart of the silver market here. This is today's silver price. So not a lot of action today as we're speaking on Tuesday. Of course, this extends to the rest of the earlier this summer as well. Now, interesting commentary I've received from some other silver analysts I've spoken to this year, and a lot of people have told me that if you look at the COMEX, for example, there's been many periods where you see a large amount of volume happening overnight, which coincides with a dramatic drop in the price. This may suggest that traders are either from financial institutions or otherwise are dumping huge amounts of lots usually in an illiquid period of time on the markets. So they're smashing down the price, so to speak. Maybe that's keeping the price down. Can you comment on that?
Well, first off, I wouldn't say that anything's keeping the price down. The price is about $22. It's up sharply from a year ago or 2 years ago. So I'm not sure that the price is being kept down. Second thing is that what you're talking to, and we've supplied you some data about this. You have conflict entrepreneurs, people who try to sell precious metals based on fear and ignorance, and they pick one or two periods and they say, "Oh, if you look at it, there's this large amount of trading volume on the COMEX in the Asian trading hours when the market's illiquid, and it has smashed the price down." And what they're doing is they're being very selective in their use of information and data. Because if you go back, and we've done the work and we presented some of the results at the Silver Symposium and other places, if you just take a slice of the market, January and February of this year, looking at the March COMEX contract, during those 2 months, there were 5,287 10-minute periods of trading. During those periods of time, the vast majority, about 96%, actually occurred with 2,537 or fewer trades in a 10-minute period. And you look at the outliers, and there were like 207 or 209, I think 207 periods of time with third standard, fourth, fifth, sixth standard deviation volumes. So you look at those periods of time and you say, there are 207 periods of high volumes. These guys are focusing on one and saying, look, it must be some nefarious bank smashing the market down. They're not looking at the entire data set, and they're not looking at the trading patterns on either side of that high volume period. If you look at the data, what you find is that of 203 periods of time, 97 of them were periods where the trading volumes were rising and were abnormally high, more than third standard deviation or greater. 97 of those were corresponding to rising prices, and 90, I have to put my glasses on, 95 of them were corresponding to down prices. Then you say, okay, well, let's talk about this. Of the periods when the price was falling, 92% of those periods actually occurred in New York or North American trading hours and not Asian trading hours. And if you look at the periods of rising prices, you see that about 50% of them occurred in Asia and 50% occurred here. Then you stop and you say, wait a second, you're saying that the major markets are closed in Asia, but China and India are the major markets for gold and silver and are very large participants in the COMEX. And then you look at the trading data, and you look at all 5,287 periods, and you find that the Asian trading hours are not a particularly illiquid time compared to the North American trading volumes. So by looking at all of the data, you can understand a little bit more about how commodities futures trade. And you can see that this guy or these people who are conflict entrepreneurs who are trying to feed the fears of investors, they're selectively picking one or two periods of time and they're ignoring the broader market. Then you can say, okay, what about gold? What about other commodities? And you find similar trading patterns. So what you're doing is you're taking one slice and you're saying, okay, this slice of bread is moldy, and it's not. The whole loaf is moldy, or vice versa. They're very selectively picking data to try to support their argument, and they're ignoring 99.9% of the data that refutes their argument.
COMEX data doesn't tell you where those trades are coming from, does it?
Not the publicly available data.
Okay, well, do you have an idea as to who's making these trades in high volumes?
Well, that's the other thing that, I've always known this, but I've never said it, because these guys are, we should be talking about something important, not this. This is just a giant distraction. They say that banks are the high volume traders, but if you look at high volume trading on commodities, it's the institutional investors, not the banks, that really are the high volume traders. And the institutional investors say, if these guys want to blame the banks and say that the banks are the guys coming in with large volumes, let them. They don't. We really don't want to know. We really don't want them focusing their ire on us. Let them blame the banks for our behavior.
Their behavior for what? Their behavior for
large volume trading.
Okay, which is would that be unusual? First of all, is that unusual behavior for commodities? For any commodity?
It's universal. It's universal across markets.
Okay, so what am I asking,
it's something
Jeff?
That anybody who's involved in commodities trading ought to know.
Somebody might ask you, Jeff, if the information that you're citing is not publicly available, where are you getting the information from that institutional investors or traders are making these high volume trades?
There is a fair amount of academic research on commodities futures that people can go on the internet and search for. Say, good research on commodities, and you'll probably get a whole bunch of studies about that. I mean, there's a tremendous volume of data, of research based on real data that's been made available to researchers, to the government, to governments, and to researchers, academic and industry analysts.
Generally speaking, would you consider the silver market in the futures markets to be a very illiquid market? Would you characterize that market using that word?
I'm sorry, what was the question?
Do you think silver is an illiquid market to be trading in?
It depends on what you're comparing it to. Silver is highly illiquid compared to stocks or treasuries or gold. The silver market's probably 1/10 of the liquidity of gold. But if you compare it to platinum or palladium or some other commodities, it's an extremely liquid market.
Right.
So it's not a highly liquid market, and it's what economists call extremely asymmetrical, in that the information availability is skewed and it's not equally distributed across the market. So you'll find people who say, well, the efficient market theory says that silver options and gold options should be priced more cheaply than they are. Why is that? And the answer is no. The efficient market theory says that if this market were efficient, by which economists mean the information was equally and symmetrically dispersed across the market, then the options prices would be lower. But all markets are to some extent asymmetrical, and the silver market is probably much more asymmetrical than the equity markets, for example, because the equity markets have the SEC saying you've got to disclose all of this information. So the information is, fair, and then there were fair disclosure laws that came into play 20 years ago. So you have a more symmetrical distribution of information in equity markets, whereas in the silver market and the gold market, there's a tremendous amount of privacy in the
people are telling me
market.
People are telling me also that the banks have a tremendous amount of short positions on paper silver. Is that true?
The short positions are hedges of the long positions they have in the physical market.
Yes, but do they have an incentive to be shorting, to be net short the metals right now?
No, they're
that's
not
what
net short. this is another thing that if you don't know what you're talking about, you can make that conclusion, right? They are not net short. Most banks and trading companies have credit provisions in their credit agreements that say they go home at some point in any 24-hour period, they are net 100% hedged. And the credit providers say you cannot do this. And we've talked about this for years, and we've shown how, a bank will have a very large physical silver market position, and it will hedge some of that in the futures market by shorting the futures. So it has a short futures position. In addition to that, investors on the futures market basically want to be long, especially in silver. They're almost always long. There was a short period of time a few years ago where they went net short. And somebody has to take the other side of that contract. And that happens to be a futures commission merchant, i.e. a bank. So those short positions on the futures market are actually hedges of physical positions. Now, the physical metal that they own, they lease out. They lease it to producers, smelters, refiners, fabricators, wholesalers, retailers, and a host of other companies, right? And banks make their money not only in silver and gold, but in dollars by charging a small fee on large volumes of transactions. So if a bank is charging 3% interest to lend a fabricator silver, and the price is $10, well, he's going to make 30 cents. If the price goes to $30, he's going to make 90 cents. So the banks actually make better. When Sprott tried that whole scheme back in 2010, 2011, let's bankrupt JP Morgan by driving the silver price up. JP Morgan had record profits in its silver contracts in its silver business that year, because the price did go from like $16 to $38, and they were making 129% more on their leases, which is where they make their money, than they had been at $16. Mm-hmm. And because they're fully hedged, they have no price exposure per se, in that if the price rises, they don't lose money. If the price falls, they don't lose money. The price rises or falls, they don't make money on the price change. But because they're leasing things out, they're leasing it out at a percentage of a higher price. So they actually benefit from higher prices. So when you look at the argument, I mean, if you went to a trial and you said, Your Honor, look at the evidence, this guy is shorting the market to suppress the price. The legal system would say, wait a second, he has a vested interest in higher prices. He makes more money at higher prices. So you're telling me that your conspiracy is predicated on the concept that this guy is working in his own worst interest. Because a bank that is a bullion bank makes more money at higher prices, not lower prices.
I understand.
And if you understand that, then you can say, Jesus, David, we've wasted 15 minutes here. We should have been talking about something important, because this is all nonsense.
Well, I appreciate your clarification. I think a lot of people in the silver market would still benefit from some.
They're not actually in the silver market. They're not actually in the silver market. They're just casual observers.
Regardless, I'm going to end on your forecast now. $30 silver. Can we get there before December 31st?
We can. I doubt that we will. I mean, our forecast right now, we'll be coming out with a new forecast on Thursday with our precious metals advisory for October. But right now, our projections are that we think the price will trade between 22 and 28. So we don't necessarily think that we'll get to $30 yet this year, but we're looking for more sideways movement.
Excellent. Jeff, I want to thank you so much for coming on the show today. Appreciate your thoughts.
You're welcome.
Thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel and follow me on Twitter at DavidLin_TV.